If you scalp the market and keep losing, it's not because your strategy doesn't work. It's because you're trading like a small fish and you don't understand how the sharks trade. Let me show you what trading like a small fish actually looks like. Look at this market, it's ranging. Price keeps reacting around a major level. Now watch what most traders do. Price breaks out of the range. You think, that's it, the move is starting. You enter, you place your stop loss. And what happens? The market goes against you. Loss number 1. Then price breaks below support. Now you say, okay, new downtrend, you sell. And again, the market goes against you. Loss number 2. Then price breaks above resistance. You get excited, you buy. And once again, the market goes against you. Loss number 3. Same market, same levels, same result. This is exactly how 99% of traders trade. And while you're clicking buy and sell, the sharks are doing one thing. They're taking your liquidity. Now at this point, you might be thinking, okay, this is just another liquidity trading strategy. It's not. And let me show you why. Look at this market. Price hits this level and reverses. It comes back again and reverses. This level starts acting as support. If you trade liquidity, you already know what this means. There's liquidity sitting below this level. So what happens next? The market breaks below support, and then it closes back above it. This is what most traders call a liquidity sweep. You think, okay, this is a liquidity sweep. You enter, you place your stop loss. And once again, the market goes against you. Another loss. So the problem is not spotting liquidity. The problem is knowing when the sharks are actually committed. In the next few minutes, I'm going to show you 3 simple steps. Steps that help you spot when sharks are actually moving and avoid fake liquidity sweep traps. Let's start with the first step. Step 1 is identifying the shark move. Institutional activity is complex, but on the chart it always leaves only 2 clear footprints. An aggressive move up with a pullback or an aggressive move down with a pullback. That aggressive move is where institutions enter the market. That's when real money steps in. The start of that move is what I call the shark zone. This zone is not random. It becomes a reference point for institutions. Once sharks reduce part of their positions to take profit, the market starts pulling back. And the best area for them to re-enter is that same institutional zone. But when price returns to the shark zone, institutions need liquidity. They need buyers or sellers to trade against, so they can drive price higher or lower. That's why they create liquidity sweeps. After a strong move up and a pullback, before the next expansion, sharks sweep liquidity. The same logic applies after a strong move down. If you know how to spot this shark behavior, you stop chasing moves. You know when to wait, and you enter only when the market shows its hand. If you're losing using liquidity for scalping, it's not because liquidity doesn't work. It's because you're trading random levels, not institutional zones. Let me show you. Look at this chart. This is a shark move. A strong move followed by a pullback. You say, okay, I'll wait for price to come back to the institutional zone. Price reaches the zone. A liquidity sweep appears. You get excited, you enter, and you lose. Why? Because that wasn't an institutional zone. It was a random market move. Now compare these 2 charts. On the right, a random move. On the left, a real shark move. They look similar, but they're not the same. So the real question is this: how do you identify real institutional zones created by sharks and avoid the fake ones? That brings us to step 2, shark zone evaluation. Before you think about entries, you need to know how to evaluate an institutional zone created by sharks, because this is where most traders get fooled. At first glance, many zones look clean, they look technical, they look tradable, but most of them are not institutional. So here's how you separate a real institutional zone created by sharks from a random market level. The first thing you evaluate is how price leaves the institutional zone. When sharks create a zone, price doesn't drift away, it leaves with strength. You'll see large, decisive candles, clean bodies, very little hesitation. That's not randomness, that's institutional commitment. But if price leaves the zone slowly, small candles, mixed colors, long wicks, stop right there. That zone was not created by sharks. It was created by random market activity, and random zones don't pay scalpers. Next, you evaluate the integrity of the institutional zone. A real institutional zone is fresh. It hasn't been reacted to yet. The first return is where institutional interest still exists. Once price has already interacted with the zone, that edge fades. On lower time frames, many zones appear. Only zones with high institutional integrity matter. Fresh institutional zones create fast reactions, and fast reactions are where scalpers make money. Now, this is where most traders get it wrong. A real institutional zone must cause structural change. Price must break a previous high or low when leaving the zone. That's how you know sharks were involved. If price leaves a zone but doesn't break structure, nothing changed. And if nothing changed, that zone has no edge. Institutional zones don't just react, they reshape the market. Finally, you evaluate asymmetry. Even if a zone looks perfect, you don't trade it unless the reward clearly outweighs the risk. Minimum 3-to-1. No exceptions. Sharks don't trade often, they wait for imbalance. And that's exactly what you're doing here. Step 3 is timing the entry, not guessing it. Up to now, you know 2 things. You know how to identify a real shark move, and you know how to evaluate whether an institutional zone is real or random. But none of that makes you money until you know when to enter. This is where most traders still fail. Most traders enter as soon as price touches the zone. They see a clean institutional zone. They see price coming back, and they click buy or sell immediately. That's not how sharks trade. When price returns to an institutional zone, sharks don't enter right away. They need liquidity, they need traders on the wrong side of the market, they need stop losses to trade against, and that's why liquidity sweeps exist. You're not entering on the zone. You're not entering on the first reaction. You're waiting for traders to get trapped inside the zone. That trap is what we call a liquidity sweep. And here's the key difference. The sweep is not the entry. It's the signal. Look at this chart. Price makes a strong move up. A pullback forms. This looks like a perfect institutional zone. Most traders enter right here, on the first touch. What happens next? Price dips slightly, hits their stop, and then moves in the original direction. This is where traders say, "My stop was hunted." No, you entered before liquidity was taken. Now look at this one. Same setup. Strong move, pull back into the zone. This time, price dips below the zone a couple of times, then closes back above it. You think, okay, liquidity sweep. You enter. And again, price moves against you. Why? Because this was not a strong institutional zone. Remember one of the key criteria of a shark zone. It must be untouched. Look at this zone carefully. Has price already reacted here before? Yes. That means this zone has already been used. And once a zone has been used, institutional interest is reduced. The highest probability is always on the first return. If price has already interacted with the zone before, you skip the trade. Now look at this example carefully. Strong move. Clean institutional zone. Price returns. Liquidity is swept above the zone. A close below is the confirmation. The candles are strong. The move is fast. Previous support is broken. This is a real shark zone. This is where you enter. No guessing. No anticipation. And look at the result. The market moves in your favor. Because when you respect shark rules, the market rewards you. But when you trade randomly, the market destroys you. Now keep watching, because if you miss this part, it's like you never watched the video at all. Everything can look perfect. The institutional zone, the liquidity sweep, the entry confirmation, and the trade can still fail. Let me show you why. Look at this chart. On the 5-minute chart, the setup looks clean. All the criteria are respected. But now zoom out. Look at the 30-minute chart. The market is ranging. And inside that range, there is massive liquidity sitting above and below. More importantly, strong money is positioned right here. That means the higher time frame still allows price to move up. And that is the opposite of what we're trying to do on the 5-minute chart. So even though the 5-minute setup looks perfect, it is trading against higher time frame intent. And when you trade against higher time frame intent, liquidity setups fail. This is why top-down alignment is not optional. It's a requirement. If your lower time frame trade is not aligned with the higher time frame, you are not trading with sharks. You are trading into them. So, here's the rule you need to remember. Before you take any entry on the 5-minute chart, you must ask one question. What is the higher time frame allowing price to do? Now, look at this chart. This is the Australian dollar against the Canadian dollar on the 5-minute time frame. As you can see, the market makes a strong move here. So the first question is this a shark move? Look at the candles. They're large. The move is fast. And a previous resistance level is clearly broken. So far, everything looks perfect. Now watch what happens next. Price retraces back, dips below the zone, and then closes back above it. That's a clear liquidity sweep. But notice this. We do not enter yet. Before doing anything, we check the higher time frame. Now switch to the 30-minute chart. Here, price hits this level and reverses, forming a clear support level. Price retraces, breaks below the level, and then closes back above it. That's a liquidity sweep on the higher time frame. And that tells us something important. The market is likely to move up after taking liquidity, which means the higher time frame is supporting our idea on the 5-minute chart. Now we switch back to the 5-minute time frame. At this point, you know you're trading with higher time frame intent. You enter at the close of the candle that confirms the liquidity sweep. Your stop loss goes below the zone. Your target is the next key level. Now look at what happens. As expected, the market moves directly to the target. What I've shown you so far is only half of the picture, and honestly, if you stop here, you're still leaving money on the table. Because what I'm about to show you next is the other 50%, the part most traders never see. So stay with me. The strategy you're about to learn is called the Institutional Liquidity Reversal Framework. Its purpose is simple: to catch the real move that happens after the fake one. But here's the most important thing you need to understand. This is not a strategy you trade all day. Timing matters, structure matters. This framework is only valid during specific sessions, the London session and the New York session. Outside of these sessions, the framework does not apply. To trade this properly, you only need one simple free indicator to mark trading sessions on your chart. Here's how to set it up. Open Trading View. Click on Indicators. In the search bar, type Sessions. Select the indicator called Sessions, created by JRFX-Addict. Now, if your chart background is dark, you might not see it clearly at first because the session colors are dark too. So go to the top right, find the indicator name, and click the settings icon. Uncheck the Asian session. Set the London session opacity to 50. Set the New York session opacity to 50. That's it. Now your chart is clean. London is marked in green. New York is marked in red. Now here's how the framework works. First, during the London session, you identify the most recent key level. In this example, this resistance level is the most recent one. That level becomes your reference. Then you wait. During the New York session, price returns to that level. Look at what happens. Price reaches the level, breaks above it, and then closes back below. That is a liquidity sweep. This behavior repeats in the market because institutional participants execute orders this way. Retail traders react to the break. Institutions use that liquidity to position for the real move. The Institutional Liquidity Reversal Framework is executed on the 5-minute chart. That's where entries are taken. That's where risk is managed. And in the next part, I'll break down the exact entry rules, the stop loss placement, and the profit targets, step by step. Now look at this chart example. This is the euro against the US dollar on the 5-minute chart. As you can see, during the London session, the market was trending upward. And this right here is the most recent major resistance level. Now watch what happens during the New York session. Price moves up, breaks above that resistance level, and then closes back below it. This is a clear liquidity sweep. And this liquidity sweep is valid for one reason. It happened during the New York session, at the most recent resistance level formed during the London session. Now how would most traders take this trade? You enter at the close of the candle that creates the liquidity sweep. Your stop loss goes above the level. Your target is the next key level. And if you look at what happens next, the market moves directly to the target, exactly as expected. But here's the important part. Is it really this simple? No, it's not. And if you trade this setup using only these steps, you will eventually blow up your account. So keep watching. Because there's one more condition you must understand before you trade this consistently. Now look at this chart example. This is the US dollar against the Japanese yen on the 5-minute chart. This level here is the most recent major resistance formed during the London session. Now watch what happens during the New York session. Price pulls back, tests the level, moves down, then comes back again. Price approaches the level, breaks above it, and then closes back below. At first glance, this looks like a perfect liquidity sweep. This is where most traders get excited. You place your entry, you set your stop loss, you set your target, and then look at what happens next. The market moves against you. Why does this happen? Because you ignored one critical factor: higher time frame alignment. If you trade on the 5-minute chart, you must always check the 30-minute chart. So let's go back to the candle that created the liquidity sweep on the 5-minute chart. And now switch to the 30-minute time frame. Look at what's happening here. On the 30-minute chart, the market was ranging. Then price breaks above the range with strength and continues moving upward. That tells us something important. The higher time frame is bullish, which means it is completely against our short setup on the 5-minute chart. Now switch back to the 5-minute chart. At this point, we know the higher time frame is not aligned. And because of that, this trade should be ignored. This is one of the most important conditions you must respect if you want to avoid losing trades. Now let's apply this rule to the next trade and see how it works when everything is aligned. Now look at this chart example. This is Solana against the US dollar on the 5-minute chart. As you can see, this is the most recent major support level formed during the London session. Now watch what happens when price reaches that level. Price breaks below the support and then closes back above it. This creates a liquidity sweep, and this is exactly what we're looking for. But before entering, we check the higher time frame. So now let's switch to the 30-minute chart to see whether the market is aligned with our trade idea. As you can see on the 30-minute time frame, the market is moving higher, following this clear uptrend line. That tells us the higher time frame is aligned with our setup. Now we switch back to the 5-minute chart and execute the trade. We enter at the close of the candle that confirms the liquidity sweep. Our stop loss goes below the level. Our target is the next resistance level. This trade offers a 4-to-1 reward to risk ratio. Now look at what happens next. As expected, the market moves directly to the target. This is the power of following clear rules and respecting higher time frame alignment. When you do that, you stop guessing and start trading with structure. If this video helped you, give it a thumbs up, subscribe, and turn on notifications so you don't miss the next one. Thanks for watching, and I'll see you in the next video.